Joining us is Tom Murphy. Tom is managing partner and co-founder at Family Office Research and Management. So, Tom, what gives?
Rishaad, we've got a very interesting year ahead of us. I know that the markets have been focused quite a lot on Europe, but I do believe in my heart that next year is going to be really a split year in terms of a first half that's dominated by fears of capital drain from European bank capital raising, and then a second half which is far more optimistic. Some of the signs coming out of Asia, for example, out of China in particular, lead us to believe that we really are actually quite cheap in equity markets in the moment, and sometime mid-year, once that capital is raised in Europe, we could see a very significant turning point.
Are we seeing it already, Tom? Are we seeing these banks, as they continue their process of deleveraging, bolstering their balance sheet, that there is this equity withdrawal taking place, and we're seeing capital transfers back to Europe now, and that, of course, is draining Asia of money?
We certainly are. In fact, one of the most interesting phenomena that we are noticing is that bank syndicated loans are including fewer banks. That is, when the syndicate loan comes for rollover, some of the banks, principally the European banks, withdraw from the syndicate because they really have two choices ahead of them. They either have to raise capital or shrink their balance sheet. And clearly they will do both to some degree. And we're seeing that right now. And we're talking to banks here in Australia who are being offered the opportunity to increase their stakes in the syndicated loan for this very reason.
Yeah, do you get any opportunities thrown up by all this? What are you telling people that you advise?
We have actually spent the last several months doing fairly detailed work in credit markets because we've seen a number of the more esoteric fixed interest instruments which are promising yields and internal rates of return that are actually equity-like. And this is quite attractive because they're very low volatility, very secure instruments. And these instruments, if they're producing rates of return over 4 to 5 years that are in excess of 10%, with extremely low credit risk, these are very attractive for clients. So rather than increasing equity exposures today, we're maintaining the stakes but increasing credit.
Yeah, that's a dream scenario, isn't it? No credit risk and a return of 10%. I mean, where do you get that, more specifically?
It's quite interesting because a number of the instruments that trade, for example, in Europe and to some extent in the United States, where the name recognition is a bit of a problem, like an Australian bank, for example, trading in Europe or trading in the U.S. Some of those debt instruments are actually quite mispriced relative to the same instruments trading in our home country. So we try to look at those opportunities where the institutional clients we represent here are knowledgeable about those banks, very comfortable with increasing exposure to them, and we're seeking out the instruments that happen to be foreign currency denominated. We don't need to take the currency risk. That can be swapped back. But we are finding these instruments time and time again, and they are very, very mispriced.
All right, let's also take a look at this part of the world right now and the China story. Do we continue with that looking ahead? I mean, everybody's talking about some sort of slowdown, perhaps a soft landing. What's your view?
Your previous story with your correspondent in Shanghai gave some very interesting statistics about the property prices in the residential side in China. And we do know that there has been some overbuilding, and there are some pockets of the market that are stretched. But at the same time, on the optimistic front, if we look at what China did very recently with the reserve requirement, we've said to our clients that the reserve requirement lowering that occurred a couple of weeks ago is a precursor to a general fall in corporate lending rates in China next year. Now, I'm not reading this from very many strategists in the market, but I do see that the monetary supply growth in China that we experienced after the infrastructure injection of 2008 and 2009 is now behind us. China's inflation problem is no longer the problem it was only 6 months ago. And I think China's monetary policy stance is shifting as we speak. And that, in the second half of 2012, could produce some very significant buying of Chinese shares, which we believe are currently quite cheap.
Well, they're cheap because they've not really done anything for the last 2 years, essentially. In fact, I think we're 21% down at the moment on the Shanghai Composite. So you're saying, hold off, buy shares selectively, and you're looking at the latter half of next year. But when will that sort of move be priced in?
I think that would be priced in early in the second half, and it would be priced in after the European banks have achieved a capital adequacy standing that markets around the world are comfortable with. We're not that far off that point. And I think that the first bank in Europe that actually raises equity capital and surprises the market with it, and that might be from the sovereign wealth fund, that'll be a first mover advantage for that bank, because that will attract share capital to that bank and possibly rally the shares at a time when people think the worst place to be is European banks. Now, we're not there today, but we will be there within 6 months. So I'm cautiously optimistic on that one.
Tom, thank you so much for your time. Tom Murphy there joining us from Sydney, from Family Office Research.